Are you ready for a financial revolution that will shake up the world economy? Well, hold on tight, because it's coming sooner than you think. Finance experts are already buzzing about this game changing development, but don't worry, we've got your back. InvestWise offers key investment insights for your success. Join us in navigating the world of finance, and don't forget to like and subscribe for the latest updates. First up, we're taking a closer look at the mind boggling acquisition of 400 metric tons of gold by central banks in the third quarter of this year. This unprecedented event has sent shockwaves through the international finance scene, with a surge in demand and a major impact on the market. But who is the mystery buyer behind this historic move? That's still up for debate, with Russia and China among the top contenders. Intrigued yet? Keep watching to find out more. As it currently stands, Russia is more open about its gold dealings compared to China. Nevertheless, with ongoing geopolitical strife and escalating tensions among various countries, Russia's transparency is likely to wane over time as they aim to safeguard their strategic interests. This brings up concerns regarding potential manipulation of gold prices and the enduring consequences on the global economy. It is important to note that 2010 signified a crucial turning point in the gold market. For almost 4 decades, from 1970 to 2010, central banks were net sellers of gold, their sales surpassing acquisitions. This pattern led to a decline in gold prices throughout 2010, which affected both investors and countries maintaining gold reserves. It should be highlighted that not all nations participated in selling off their gold reserves. Between 1950 and 1970, the United States lost tens of thousands of tons of gold, while Switzerland lost an astounding 1,000 times that quantity. As central banks transitioned into net buyers, interest in gold surged from various nations, including China, Mexico, Kazakhstan, the Philippines, and Vietnam. The extent of Russia's involvement in gold buying remains unclear, as official figures may not reveal the full scope of their acquisitions. Meanwhile, Turkey has emerged as a major player in the gold market, with a rapidly increasing gold reserve that has positioned the country as a key influencer in the market. Japan has had a long-held substantial gold reserve and has never publicly disclosed the exact amounts. This has led to speculation and intrigue among analysts who continue to question the nation's intentions and possible influence on the gold market. As more countries turn to gold as a safe haven and a hedge against economic uncertainty, the demand for gold is expected to increase further, leading to a potential price fluctuation and market volatility. The recent surge in gold purchases by central banks is a significant development that has far-reaching implications for the global financial landscape. The involvement of major players like Russia, China, and Turkey in this record-setting phenomenon raises questions about transparency and the potential manipulation of the gold market. As demand for gold continues to grow, nations and investors alike need to remain vigilant and monitor market trends to ensure stability and security in the face of economic uncertainties. Another intriguing participant in the gold market is Iran. Despite their secretive nature, it is known that Iran has been actively purchasing gold. In one instance, Iran's gold supply skyrocketed from 600 to 900 tons in a single month. While the sudden increase initially raised eyebrows, it was later revealed that Iran had possessed the gold all along and chose to disclose their holdings due to the improbability of a single country or order requiring 300 tons of gold in such a short time frame. As the global gold market continues to evolve, it is evident that various countries are increasingly investing in this precious metal to diversify their reserves or hedge against economic uncertainties. The exact motivations and strategies behind these massive gold purchases remain open to interpretation and analysis, making the gold market a fascinating area of study for economists, investors, and policymakers alike. In the United States, people generally shy away from purchasing gold, and this sentiment may also be prevalent in Canada and other countries. However, central banks have a markedly different perspective on this matter. Inflation is a commonly understood economic phenomenon, causing prices to rise and the value of money to diminish. Nevertheless, two primary types of inflation warrant attention: cost push and demand pull inflation. The current oil crisis and the ongoing financial and economic conflict between Russia and the United States can be attributed to supply-side cost-push inflation. Initially instigated by the United States, the conflict has since drawn in Canada, Australia, Japan, and Russia, resulting in a struggle over supply sources. On the other hand, demand pull inflation is rooted in psychological factors. For instance, people may decide to purchase earlier than planned in anticipating of rising prices. The 1970s saw a combination of cost-push inflation driven by the Arab oil embargo and demand-pull inflation fueled by a booming economy, until Paul Volcker eventually curbed it. Today's inflation is influenced by supply-side factors such as increasing fuel prices, which in turn impact the cost of transportation and ultimately the price of consumer goods. The manufacturing and distribution sectors primarily shoulder additional shortages, bottlenecks, and related costs. The Federal Reserve, Fed, cannot directly address these issues as it lacks control over producing goods like oil, bread, or semiconductors. The ongoing conflict in Ukraine has further exacerbated supply chain disruptions. While the Fed cannot tackle cost-push inflation, it is closely monitoring demand-side inflation and implementing measures to control it before it spirals out of control. Market participants and investors are largely unprepared for the potential outcomes of this situation, which include deflation and a severe recession in the United States in 2023. Along with a sharp drop in inflation rates, some argue that predictions of an economic downturn are overly optimistic. The Federal Reserve's quantitative easing and the current zero interest rate policy have not been particularly effective in addressing these challenges. Although it is improbable that the US dollar's status as a reserve currency will change rapidly, the Fed is preparing for a future in which the dollar loses ground to new payment systems being developed by groups such as BRICS, the Shanghai Cooperation Organization, OPEC Plus, and China. These innovative payment methods will probably transform the way that we engage in commerce, heralding a new era in the global economy. The fundamental reason behind price increases in the market is that retailers are demanding more money from customers. When the same amount of dollars can purchase less gold, the dollar loses its purchasing power. Conversely, when the price of gold drops, a smaller sum of money can buy the same quantity of gold, making the dollar more valuable. It is important to note that the gold price being discussed is in dollars, which is counterintuitive, given that the world market also operates in dollars. To better understand this relationship, we must first establish how much gold weighs and subsequently compare it to the dollar's value. Supply-side inflation has the potential to stimulate growth on the demand side, but when implemented in isolation, it often backfires. Inflation driven by increased demand tends to be self-perpetuating. A popular argument postulates that the solution lies in raising oil prices. If prices were to rise substantially, consumers would begin to reduce their spending, leading to the closure of businesses, job losses, a surge in unemployment rates, and a slowdown in the velocity of money. This chain of events is currently unfolding. The rate of inflation decline has already commenced, and it will likely accelerate more rapidly than markets and investors anticipate. Disinflation, which represents a reduction in inflation rates but not an outright reversal, can resemble deflation in its economic effects. If interest rates continue to climb, the economy could contract and even experience deflation. Deflation increases the real value of cash, making it the best performing asset, even as other assets crumble. According to the real-time data analysis, disinflation and potentially deflation may take hold as early as January, February, or March of 2023. Those who have not anticipated a drop in inflation rates may be caught off guard by the speed at which this occurs. For instance, if the return on a 10-year Treasury note suddenly drops to 2.5%, it would be a highly profitable investment in the current situation. Disinflation is often overlooked, despite its significant impact on investors, asset allocation, and portfolio management. However, understanding the nuances of inflation, disinflation, and deflation is crucial for making informed decisions in an ever-changing economic landscape. As the world grapples with economic uncertainties and shifting market dynamics, staying informed and adapting to these changes will be key to navigating the complexities of global finance. Loved this video? Subscribe, like, and watch this one too. Thanks for watching.